Well, with more on the bond market, we are joined right now by George Goncalves. He is head of interest rate strategy at primary dealer Nomura Holdings, and he is joining us now from his office in New York with what he sees ahead for the bond market. So, George, you just listened with us there to former Fed Chairman Alan Greenspan's comments that essentially the translation of all that is that we're not in a bond bubble. Do you think we are?
We're not in a bond bubble yet, but we could be in the early stages of what I've been trying to compare against what happened in the dot-com bubble of 1999 and 2000, where yields get too low and they keep going lower on the anticipation that the Fed is going to be there to buy you out at much higher prices and lower yields. We're not there yet. I think that the Fed doesn't want to achieve that. They want to keep rates in a low range to keep the refinancing of mortgages and to keep rates stimulative to the economy. So they're not trying to create a bond bubble, in my opinion.
Yeah, because George, I remember speaking with you about a year ago about whether or not it was time to stop buying treasuries, and here we are a year later, and many people can't quite believe the prices, which brings us to today's data. Of course, jobs data, very much a focus point for the Fed, for people looking for jobs, for economists. What kind of number would we have to see today where you would see a clear direction that the Fed would take?
I think we've got to take a step back and realize that there's been a lot of bullish sentiment now priced into the bond market in anticipation of QE, predicated on worsening, economic numbers. I think we would require a really, really big number to sway the hands of the Fed into a shock and awe type QE. We believe they're going to do a very gradual, methodical approach, and if that's the case, then rates really don't have much further to decline from here.
What kind of catastrophe number, George? Right now I'm just playing hypotheticals, but could we have to see today for the Fed to do, as you call it, a shock and awe plan instead of a gradual one?
I think it would have to be something in the huge negative numbers of a couple hundred.
Okay, in other words, non-farm payrolls, 200,000 jobs taken from the economy in September, something like that?
Something in the order of that or worse.
All right. Speaking of worse, there's been a lot of voices talking about inflation, and then you have just as many concerned about deflationary pressures. Where do you stand on the argument? Where do you see this affecting the curve?
We still see disinflationary pressures in the economy, but we think we will avoid the deflation outcome that a lot of people are pricing into the bond market right now. So I think what we're starting to see, there's a dichotomy between what nominal treasuries are doing and what tips are doing. Tips are pricing in inflation, whereas nominals are suggesting that rates are going to stay low for a long time period because of deflation. I think that the odds are that we will see more inflation down the road. That's the Fed's goal. If we were to gauge the Fed's success, I think it would be in higher inflation, tighter corporate spreads, tighter consumer lending rates, not in lower treasury yields. I think the goal is to get stimulus into the economy. The goal is not to get everyone into treasuries.
All right, George, we'll leave it at that. Thank you very much. George Goncalves joining us there from Nomura.